Jai Shri Ram, Sri Guru Bhyo Namaha. Hi guys, let's move on to our second topic in topic number A1 financial statements, which is A1.2 notes to accounts. I know. Very few students actually pay attention to the notes to accounts, sir, because all of us are very much interested in preparing profit and loss, which is your income statement, preparing a balance sheet, preparing cash flow statement. Again, statement of changes in equity, you guys don't pay much attention to, but 90% of the students, their major attention would be to P&L, balance sheet, and cash flow statement. Very few students actually pay attention to the statement of changes in equity and notes to accounts. But I want you to first tackle out these most missed out ones, because it's very easy for you to take these topics for granted. So first, if I cover them off, you will make sure that you will understand these topics. That is why I'm first covering notes to accounts in detail. Then we'll move on to, again, your favorite topics, P&L, balance sheet, cash flow statements. We'll discuss them so on as we move on. But I would like to first cover up the basics very clearly before we move on to the important topics. So now if I talk about notes to accounts, sir, as we discussed in the previous lecture itself, notes to accounts are basically an explanation to the topics which are already covered in your P&L, balance sheet, cash flow statement, notes, changes in equity statement. So all the items of your financial statements, P&L, sales, cost of goods sold, operating expenses, non-operating incomes, non-operating expenses, taxes, all these items will need further explanations which are given in detail in the notes to accounts. Let's say your balance sheet has something called as property, plant and equipment, which you guys might know as plant and machinery. Olden days we used to call it plant and machinery. Now it is covered as property, plant and equipment. It's okay. So let's say in property, plant and equipment, you are having 10 million worth of property, plant and equipment in your balance sheet. Now, a shareholder would like to know what is the opening balance of that PPE, property, plant and equipment. Did you purchase any new machineries during the year? Did you sell or dispose any assets during the year? What is the depreciation on the assets during the year? Is there any increase in the value? Like land is there, it was originally purchased for 2 million. Now the market price is 3 million. Increase in the market valuation, revaluation, we call it as. So is there any revaluation gain? Is there any impairment loss like damage to the machinery, fire accident, earthquake, etc., etc.? So whatever happened. So a shareholder would like to know the breakup of this entire 10 million you are showing in the balance sheet. The detailed calculation that is covered in the notes to accounts, right? So your notes to accounts form a very crucial, essential element for showing in your for understanding the financial statements of the company. So what are the components of notes to accounts, sir, other than these calculations and all? Yes, details, calculations, everything will be there in the notes to accounts, but apart from that, you also have so many other things in the notes to accounts, are very important elements covered in notes to accounts. What are those? Let's understand now. So the first one is explanatory information, which is what we just discussed. So explanation, information explaining what are the elements already covered in other 5 financial statements. But apart from that, here comes the remaining points which are very important now. Explanatory information is fine, pretty much understandable. What are the different assumptions that we have taken? Like for example, depreciation is there, straight line method. So carrying amount divided by expected useful life. So how did you take the expected useful life? 5 years, 10 years. How did you take that? Assumptions. Methodologies of calculation. Provision for bad debts. How did you calculate the provision for bad debts? Like that. Methodology of calculation. What are the different accounting policies you have applied in the financial statements? All these explanations you can provide, sir. Further explanations, descriptions and clarifications about what are already there in the financial statements. But apart from this also, there are so many other critical things. Let's go to those things first. So the first one is significant accounting policies. All right, what do we mean by significant accounting policies, sir? I'll go back to your +1. Okay, your +1 financial statement preparation. You used to have a question. You used to call it as final accounts, right? In your +1, sir, intermediate first year or +1 or 11th standard, whatever you are, you have done. So there you have a topic called final accounts. They will give you the trial balance, and then below the trial balance something called adjustments will be given, and then you adjust the adjustments, and then you prepare the profit and loss and balance sheet, if you remember from your plus 1 plus 2. So I would like to remind you of one point there. There used to be an adjustment called create a provision for doubtful debts, or a create a provision for bad debts at 5% of total sales in the year. Do you recall anything like this? Create a provision for bad debts. Create a provision for bad debts at 5% of total sales. So what do we do, sir? We take the sales figure given in the trial balance, and then we subtract any sales returns, then we get the net sales. On that net sales we calculate 5% provision. Okay, good. And then this provision will be first shown in debit side of P&L in the profit and loss. Indirect expense we will show it, and the second adjustment, all adjustments will be shown 2 times. I hope you are all aware of this, you remember all this. Any adjustment will be shown 2 times in the final accounts. So one in P&L debit, second one is in the balance sheet. You will subtract from the debtors balance, which is accounts receivable, right? Whatever clients receivable from your customers is there, from that you subtract this and show the net figure. So two times adjustments will be done. This is one way. Another question will say that calculate a provision for bad debts at the rate of 10% of closing balance of debtors. I hope you are all able to recall these kind of questions from your plus 1 plus 2. And another question might say at the rate of 8% of average debtors. Average debtors means we have to take again opening balance plus closing balance divided by 2. We calculate average of the sundry debtors. On that we calculate 8%. So this percentages may change. Some questions based on the facts the percentages might differ. But here what I want you to pay attention to is, in one case we are calculating on total sales, in another case on the closing debtors, in another case on the average debtors. Again, some questions they might say on the credit sales only, not on the total sales. Sir, cash sales may you don't have bad debts. Cash sale means already you got the cash. There is no concept of bad debt. So only on credit sales you are expected to calculate the provision for bad debt sometimes. So what are these things, sir? These are different accounting policies of the company. Understand, my dear friends. These 3 are called as accounting policies. Not only these 3, there are hundreds of accounting policies. Okay. Again, if I go to inventory, you might remember inventory chapter. Inventory means stock in hand. So there in inventory you have Indians, you have 2 methods if you remember. One is actually you learned all the 3, so that's fine. You learn something called FIFO, first in first out, LIFO, last in first out, average, weighted average valuation of stock, cost calculation. Do you remember this FIFO method, LIFO method, at least the names? So what are these, sir? These are again accounting policies. Company can choose between any of this. Company can choose between any of this. So there is a choice. That choice is called accounting policy. So sir, don't you think your shareholder should know which accounting policy you are using? They should know. That is why notes to account includes a section called significant accounting policies. So you can see this includes the methods used for recognizing, measuring and presenting various assets, liabilities, revenues and expenses. How did you calculate? Which method did you use? What assumptions did you use? All these things will be covered in significant accounting policies. It is very important the company discloses these things. So if you want to know whether a company is following straight line method or written down balance method for depreciation, you can go and look at the notes to accounts. In the significant accounting policies, you will find that. If you want to know how did the company calculate provision for bad debts, go to notes to accounts and check significant accounting policies. You will find that there. Okay. Next, third one, contingencies and any firm commitments. Okay. Sir, you are looking at the company's balance sheet and the balance sheet is looking absolutely fine. No problem, sir. Okay. Sorry. So you are looking at the company's balance sheet and the company's balance sheet is looking fine. You saw the assets of the company, you saw the equities and liabilities of the company and everything is looking okay. You don't have any problem. So you invested in the shares of this company, you purchased the shares of this company. Later on, you came to know that unfortunately there was a court case pending on this particular company. There is a legal case pending in the court of law. Okay, some client has filed a quality case, like your product is not qualitative enough, or if you are into food manufacturing or food production, there is some health issue because of your product, or if you are into cosmetics, there is skin issues because of your using your product. So somebody filed a legal case against your company, or you used the trademark of somebody else without their permission, so there is a defamation case filed on your company. Whatever may be the reason, there is a case pending in the court of law. And after you purchase the shares of that company, the court has given a verdict against the company to pay a penalty of 5 million. Now what will happen, sir? As a shareholder, you invested in a company without knowing the complete details. So you went to the company and shouted at them, why you did not show it as a liability in the balance sheet? You should have shown it as a liability. I would have not invested in your company. The company said, sir, sorry, it was not a liability when we prepared the balance sheet. The court did not give a verdict on the balance sheet date. At that time, we don't know whether the case, we will win the case or we will lose the case. So why will we show it as a liability? It is not there. We don't know whether it is 3 million, 5 million, 10 million. We don't know. That's why we did not show it in the balance sheet. So now you don't have a cross question against that. That is why notes to accounts you have to read, sir. In the notes to accounts, you have a section called contingencies and commitments. Contingencies means what, sir? Something that may or may not happen in the future. Contingency may or may not happen. We might win the case, we might lose the case. Then also you have to show it in the notes to accounts. It is your obligation to show it. Look at this. Contingencies such as any pending legal disputes, any potential liabilities that might be there, they might affect the company's financial position. Sir, they are not there yet. At this point, we don't have a liability, but there might be a liability in the future. That also must be shown in the notes to accounts in the contingencies and commitment section. Sir, what are commitments? Like, for example, the company has signed a lease agreement for next 10 years. Shareholders should know that. What are the committed liabilities for the next future? Long-term contracts, lease liabilities that could affect the future, that also will be shown in the notes to accounts in the contingencies and commitments section. All right, next you have something called related party transactions. So name itself is very clear, transactions with related parties. Who are related parties, sir? Company has a subsidiary company, company has an associate company, entered into a joint venture with somebody else. Company's board of directors are also directors in another company, so that company becomes a relative. Similarly, one of the key managerial person, let's say the chairman of the company, his wife is the chairman in another company, and that company is transacting with this company. Related party transaction. So shareholders should know the related party transactions, sir. Why should we know it? Sir, usually related parties के साथ fraud, I mean, sorry for using Hindi, there is a chance that when we do transactions with related parties, there is a chance that there might be a fraudulent transaction. There is a possibility of committing a fraud against the company. Unfavorable prices, market price is 500, you are purchasing at 800 from your friend to give them more profit. So related party transactions, any transaction with a related party should be disclosed in the notes to accounts. All right, so companies often engage in transactions with related parties like shareholders, directors, other entities with common ownership, same shareholders, same board of directors, same KMPs, etc. The notes to accounts shall disclose these related party transactions, including what shall we disclose, sir? What is the nature of the transaction? Is it purchase of goods, purchase of assets, sale of goods, loan given, loan taken, anything? What is the nature of the transaction, amount involved in that transaction, and what is the outstanding balance? Sir, you have given a loan of 5 million, already they paid 4.5 million, so only $500,000 is pending, so outstanding balance also you have to give. Then any changes in the accounting standards. So if you are changing any accounting standards, sir, for example, earlier we were preparing the financial statements under Indian accounting standards, IND-AS. Now we are preparing the financial statements as per IFRS or as per US GAAP. Usually these things do not happen, but assume, very rarely these things happen. So whenever you are changing your financial statements preparation, the accounting standards based on which these financial statements are prepared, if you are changing the accounting standards, that must be given in the notes to accounts. You must tell your shareholders, see, we have changed the method of preparation of financial statements. Earlier we were using these accounting standards, now we are using some other set of accounting standards. You must inform that to the shareholders. Sir, why is it required, sir? Because then only they'll be able to understand any kind of adjustments, any restatements, recalculations, remeasurements. Why are they done? Because you are changing the accounting standards. Then shareholders will understand, oh, okay, this is why this particular change happened. And according to me, the most important notes to accounts, subsequent events. Sir, there is a separate standard on subsequent events called IAS 10. Events occurring after the balance sheet date, after the reporting date, whatever you want to call it. So IAS 10, International Accounting Standard number 10 is there. But anyways, that's not my my content here. If I talk about significant accounting policies, this is covered in IAS 8. Significant accounting policies, estimates, and rectification of errors. Then contingencies is covered in IAS 37. Contingencies, provisions, contingent liabilities, and contingent assets. Related parties, I don't remember the standard number exactly, but that's okay. So like this, every topic has an international financial reporting standard or an international accounting standard associated with that. The numbers, you don't need to remember or by heart these numbers, by the way. Do not worry about all this. Okay, you don't need to by heart these numbers. Now, subsequent events, accounting standard number 10, IAS 10. What is this subsequent event, sir? I'll just tell you in short, very short. I'll tell you because you don't need to know the details of it. You are not an expert in IFRS, so we don't expect you to know all the details, so do not worry. Oh, okay. All right. Sir, why did you draw that? I'll tell you. See, imagine you are a shareholder in a company, and that company closed its books of accounts on 31st of December. Okay, it has to be either 12 by 31 if I'm talking about a US company, 2022. Sir, this is by DD format. US follow MMDD format. Why? Be very careful when you look at the dates. So this is MMDD format. So if a US company closed its books of accounts on December 31st, 2022, will they prepare the profit and loss balance sheet on 31st of December, sir? Not possible, right? Sir, they have to calculate the value of inventory, they have to calculate depreciations, they have to calculate provision for bad debts, they have to evaluate any provisions that are required, which customer might become bad debt, which customer might not default. So they'll have to assess all that stuff. They'll have to do aging schedules, they'll have to do physical verification of inventory, they'll have to do physical verification of fixed assets, property, plant, and equipment. They have to do an impairment review. Oh my god, there are a lot of final adjustments that are required after the end of the financial year. So let's say they took 2 months to do all these assessments, evaluations, measurements, verifications, and all that stuff. And let's say on 10th of February 2023, they were able to finally prepare the balance sheet and P&L. Prepare financial statements on 10th of February. They were able to prepare the financial statements. All right. Then moving on, these financial statements cannot be directly given to the shareholders. There has to be an audit done before that. So audit took, let's say, 4 months, sir. This is 2 months. This, then again, 4 months auditors took. And then on March, April, May, June. In June 15th, auditors were able to give their draft audit report. So draft audit report means what? First, the auditors will give a draft report, and then directors will check that, and if everything is fine, then auditor will give the final report. Otherwise, directors, sir, understand, auditors found out 10 mistakes in the financial statements. Director said, "Arey, we did not know this. Okay, let us correct that." So they rectified and then gave the rectified financial statement. So what is the problem, sir? Auditor will say, okay, these 10 mistakes are rectified, no more mistakes in the financial statements. So first, a draft audit report will be given with the list of observations for which the directors will take actions upon that. So directors responded by July 1st. Directors responded. Then July 15th, 2023, auditors gave final audit report. Then in somewhere in September, let's say September 10, 2023, shareholders AGM is conducted, sir. Annual general meeting is conducted. Okay, wonderful, great, excellent. Now you are sitting in this AGM on what date? On September 10, 2023. Very good. You looked at the financial statements and you found out that the company is not going in the direction which you are interested in. You wanted the company to continue its existing operation, but they are starting some new product. You do not like that new product, sir. You do not want to be an investor in that company. But understand this, the problem with that is, sir, you are sitting in September 10, 2023. You are looking at the financial statements as on 31st December 2022. That means you are looking at financial information which is 9 months old. 9 months old financial information you are reading now. Sir, will it be useful for you to take financial decisions based on that? 9 months old information. Will it make sense to you? Sir, but then we can't skip all these things, na sir. These are all very important things. We cannot skip them. So what shall we do then? That is why we have a section called subsequent events. In the notes to accounts, the directors should disclose any important events, any earthquake, fire accident, change of business operations, removal of any directors, resignation of any important directors in the company, any change, any transaction, any important event that happened after the reporting date but before the shareholders meeting. All these things will be given in the subsequent events list. Okay, see this. Notes to accounts may include information about significant events or transactions that occur after the reporting date but before the financial statements are issued to the shareholders in the AGM. They may have impact on the company's financial position or future operations and are disclosed to make sure that information is most current, updated information is given to the shareholders. So, sir, now you tell me, is notes to accounts important or not so important, sir? Maybe not so important for your exam, but as an investor, when you are looking at the financial statements of a company, this is the most important statement to look at, not the actual P&L balance sheet that will only show you what already happened. If you want to know what is going to happen in the company or what has been happening recently, you will have to look at notes to accounts, not at P&L balance sheet. If you want to read the fine print, reading in between the lines, that between the lines is notes to accounts, you should read it. So this is the most important one, which is not so important for examination, unfortunately, but very important and very crucial for you to know if you want to become a good financial professional. All right, again, the last two paragraphs are just conclusion. This is very important. This is what it does. It gives you more complete picture about the financial statement of the companies. It will talk about financial viability, profitability, stability of the company. You will know about all these things when you read the financial statements, all that stuff. But this is one point which you should know, sir. The notes to accounts, explanation in the notes to accounts, they go beyond the numbers presented. They don't just talk about the numbers, they go beyond the numbers. Why those numbers are presented, how those numbers are calculated, why those numbers are not changed. The reasons will be given in the notes to accounts, not in the P&L balance sheet. So I hope you all understood the importance and the essence of notes to accounts. So I'll see you in the next lecture. Until then, keep smiling, take care, bye bye. Radhe Radhe.